Welcome to MoneyWeek interviews. In this series, I will be speaking with a wide range of fund managers to discuss their views on the market and where investors can find the best opportunities today. In this interview, filmed in central London on the hottest day of the year in the UK, I sat down with the manager of the Odyssean Investment Trust to talk about the firm's unique investment strategy and outlook for UK small-cap equities. I do hope you enjoyed the interview as much as I did, and please stay tuned for more MoneyWeek interviews. Ed, thank you for joining us. Odyssean takes a unique approach to finding investments, and it's always taken a unique approach since its launch in 2018, and it has outperformed its benchmark on a NAV basis by a substantial margin. So I'd be curious if you could tell me, why do you think that is, and what works about your approach?
Yeah, sure. Firstly, thank you for having me in today. So we set Odyssean up in 2018, as you say, and we set up with the ambition to basically make our clients money. It sounds a bit trite, but that's what we're trying to do. We're not trying to beat an index. We're trying to deliver a good return to our clients. And we think we can double our clients' money over a 5-year period, which roughly equates to a 15% annualized return. And we think we can deliver that across a cycle. And the way we go about doing that is we draw on our heritage, which both Stuart and I, who run the fund, and even the chairman of our management company, Ian Armitage, have, which is starting our careers in private equity. And we very much bring that private equity philosophy to our approach to making investments in public markets. And we think that leads us to look at investments in a different way, what we're looking for in terms of quality, how we think about valuation, and how we think about the investment stories we're looking for in our investments. As a result of that, we tend to construct a very different portfolio of assets to a lot of our peers in the market. It means we're not growth focused, we're not valuation, we're not value investors as such. I know the market likes to quite often diverge into those two camps. We feel we're not either, and quite different. A lot of our clients actually use us as a diversifier alongside some other strategy in that bucket. So I think the core is really all about the investment approach and a different mindset we take, and that means we deliver a differentiated set of returns. And as you say, we've been fortunate enough to have a good run since IPO.
I'm curious, when you said that, you set out with the ambition to make your clients money. What made you come up with that? Do you think that's something that other investment managers don't necessarily?
Well, I think it's a little bit of a kind of a silly phrase, but I think it's actually quite important. In my mind, this actually does come from the chairman of our management company, Ian Armitage, who's very keen that, as an investment manager, your objective should be to look after your clients and to make your clients money. Our objective isn't about beating an index, matching an index. It's about delivering those returns. And yes, it's a simple thing to say, but it's very important for us, and that's how we think about all our investments. We're not focused on the short term, we're focused on the mid to long term and really delivering those returns for our clients.
Do you think, you're a relatively small trust with in the grand scheme of things compared to some of the mega cap funds that are out there. Do you think that gives you an advantage?
Well, I think it gives us an advantage in the sense that we're able to focus on a certain part of the market and be strict in our focus. So we typically invest in companies with a market cap range of 100 million to £1 billion, and we can be quite strict about that. There's a limit to how large you can grow if you're going to invest in that area and not be dragged up beyond the top end of that range. So I think by being of a smaller size, we allowed some discipline in where we focus our investments. And the reason we choose that area is because that's where our investment style works best. It's where we think we find the most opportunities in terms of mispricing, and the most opportunities in terms of businesses that can go through a transformation that will deliver a differentiated return over time. So I think by saying to ourselves, we're not just going to asset gather, but we're going to cap the size of the strategy, and we think we could probably run 500, maybe 600 million in this area of the market, but then we'd probably stop. We'd rather be disciplined and focus on what we know and what we've done before and what's worked, rather than just gather assets for the sake of growing the business. That's all part of the philosophy, right? Again, back to that, we're here to make people money. We're not here to build an empire, as it were.
Most of your investing is in the UK, in the UK equity market. I think it's one of the most disliked equity markets in the world at the moment. I wonder if your views on what is happening to the UK equity market.
We think it's a really interesting time for UK equities at the moment. You're right, it's an unloved space, and it's been unloved for, quite a long time. But if you are familiar with a lot of the market commentary at the moment, it's generally agreed that UK equities are cheap at the market at the moment. And we agree with that. In our conversations with clients recently, we've been pointing to a number of metrics, just on pure multiple basis, the markets look cheap. But also we do some more kind of fundamental analysis, looking at using tools to do discounted cash flow analysis of whole markets. It points out to us the UK is certainly trading below its fundamental value today, and certainly much cheaper than other geographies if you look broadly around the world, where it's noticeable the US remains quite highly valued, Europe probably more fairly, but the UK is a real outlier of value. Now for us, that's a really interesting opportunity, okay? We believe that the starting point for great returns was buy assets at a price below their fair value. And as a whole, we think there's a lot of opportunities in the UK today because of that malaise that's affected the market. The bigger challenge, I guess, if this market's cheap today is what's going to change tomorrow, because as you say, it's been our love for quite a long time. Our theory on this is that it's really hard to make predictions over what's going to happen in the next 3 to 6 months. But if you look through prior cycles, eventually the world does change. The headwind for the UK market over the last couple of years definitely has been outflows from equity funds. As we saw in recent set of data came out from Calastone that the last 27 months have seen outflows from UK-focused equity funds. I think that's pretty unprecedented. And that removal of money from the market has been a challenge for valuations. Now, at some point, those trends will change. The first leg of that will be those outflows abating. The second leg will be, hopefully, at some point, inflows back into the market. And as that steps of money flowing back in comes, we think there's a real opportunity for a major re-rating. And we think we can get quite excited about what that means over a 3 to 5 year period. As I say, we're not sure exactly when that will come in the next short term, the next 3 to 6 months. But over the medium to long term, you can be pretty confident at some point conditions will change. And then we look at the parts of the market we think are most interesting. We focused on small caps. And there, because the liquidity of some of those stocks is quite low, as and when money flows back into the market, it's quite hard for people to find stock in volume in the names that, for example, we've invested in. So we think the scope for re-rating, particularly in the small end of the UK market, is really quite interesting at the moment.
When it comes to outflows, have you seen a significant drop in liquidity, and is that making it harder for investors to get out and buy smaller companies?
Well, yeah, I mean, it certainly varies across the names in the small cap universe, but liquidity is not good. That's fair to say. And that provides opportunities as well as being a challenge. I mean, one of the benefits of being closed-ended fund is that when peers in the market have outflows, you can sometimes stand on the opposite side of the trade and pick up stock at attractive valuations, and that's certainly helped us over the last 12 to 18 months, we think. And going forward, we think it's one of the stories, one of the opportunities for small caps is as and when hopefully money flows back into the small end of the market. These smaller stocks where liquidity is poor, you can see quite sharp moves as and when people try and secure positions, which it's going to be quite hard to do, we think, when the market turns. So we're quite excited about some of the positions we've managed to build. It may not be 3 months, may not be 6 months, but eventually when the market turns, we think there's some real value to be had in small cap.
So what would your message be for investors then in this space? Would you say get in now, take the advantage of the opportunities?
I think our message has been pretty consistent to our clients. Again, we don't make short-term predictions. It is not possible 3 to 6 months, we don't know. But at some point the market will turn. And when it does, we think there's a great opportunity. And I think that, as I say, getting positions in those stocks after the market has turned and the market starts moving will be a challenge. So for the patient investors, we think it's a really interesting time to put some money to work in UK smaller caps in particular.
Just on the topic of investment trusts, why do you think an investment trust like yourself is a better way to invest and capitalise on the opportunities in the small cap market than a tracker fund or an ETF?
We chose the investment trust structure for a number of reasons. And I think when you think about the structure of your vehicle, it should line up with the kind of investing and the strategy you're going to follow. And so the investment trust structure for us, we don't use it for gearing. I know a lot do, and that can be a benefit. For us, it's all more about managing the nature of the assets we invest in. So the benefit of the closed-ended structure, we can take on some liquidity risk. Some of those less liquid positions, we can be comfortable in taking it on and know we're not going to get a redemption in the short term requirements to try and sell out of a position. We can take that risk on, and you get rewarded for that risk by finding interesting opportunities. You add to that, we're able to take true long-term positions. Again, we know we're going to have the capital for a long time. We can build a relationship with the management team, see an investment from start to finish, and know we're not going to have to ring up tomorrow and exit a position. That makes you a credible counterparty to a management team and lets you pursue an investment strategy to its end. And then there's concentration limits. We run a highly concentrated portfolio, typically only up to about 20 names. And if we like an idea and we have high conviction, we like to put some money behind it, and we can take a much stronger position in names we like in the investment trust structure than maybe you would under a more open-ended vehicle. When you think about the investment trust, you should use it for reasons that match your investment style rather than use it for the sake of it being the trust. And so for us, it works because of the kind of investing we do and actually helps us invest in a better way by having that structure.
And that ties back into the private equity approach you spoke about at the beginning.
Yes, I think so. I mean, when we talk about the private equity mentality, I mean, parts of that is all about running a concentrated portfolio. The kind of assets we look for typically are businesses which are good, but could be run better. And so you want to be with businesses through that transition when they do something to make themselves better understood, more efficient, deliver better returns. And that gives you a reason why the equity will grow in a way uncorrelated with the market. And so if you're thinking about having that kind of engaged long-term relationship with your investments, you need a structure that matches that. And the investment trust works really well, we think, for the kind of investing we do.
Do you think managers are more open to having you as a large shareholder because of the investment trust structure and your openness that you're a long-term investor?
I hope so. I guess you'd have to ask them. I mean, I think the transparency is also quite important. I mean, one of the interesting things for us, actually, because we run the listed vehicle, we have to go and do reporting and shareholder communication, and we understand that part of the challenge when you're in the public markets is communicating what you do and making sure investors know what your business is doing, why it's succeeding, what the challenges it faces are, how you market it, what the right kind of shareholders you should have for your vehicle are. And those are the same problems that the companies we invest in face. So this is a commonality of how we think about it. And sometimes that can be useful. I mean, one of the areas we often engage with companies is around investor relations. And we understand the challenge of, if you're a smaller cap UK equity, going out there and drumming up interest in your stock, and how important the story is, the messaging, making sure that you see the right people. And because we've done that ourselves, we understand it, we can quite often have interesting and informed conversations with the companies we invest in about how they can get their message better understood. It just helps with the rapport with management teams.
Is it a relatively, I would say, unique offering with Odyssean is the fact that you allow shareholders to exit if they want to at NAV minus costs. How does that tie into the value proposition? And do you think that's something other trusts should look into doing as well?
Well, when we set up the trust, it was very important to us setting up a new vehicle that we could put in place, basically the best quality vehicle in the market with what our customers, so our shareholders, wanted. So before we started the IPO process, we went round and spoke to a number of wealth managers, those who were influential investors in investment trusts, and what would they like to see for the vehicle. And it was their guidance around the redemption facility you mentioned that allows investors to get their money out at NAV, which really drove us to put it into the structure of the trust. So we think it's best in class. We think our job is to make sure that our investors are happy, keep the discount tight, deliver good returns, and when the opportunity comes to redeem, we hope shareholders will be more than happy to carry on. But we think that giving shareholders that option gives them comfort. And if you look at how our trust has traded since IPO, we're proud of the performance. We're probably even more proud that the average discount since IPO has been, effectively zero. Okay, which if you look at the rest of the sector, typically trades on a discount to net asset value. And we think the reason for that is a whole multitude of things, but one of them is that you put the right kind of protections and processes in for shareholders, and you get rewarded for that. So by building a vehicle that delivers what shareholders want, we benefit from a tighter discount, and they have certainty about an exit point at some point in the future.
And do you feel like that's something other trusts can learn from?
I think that the track record indicates that it does work and people like it. And there are some other trusts out there who've got similar structures. And so, yes, I think the market can learn.
So the track record speaks for itself, effectively. So I want to move on to your positions. I think your largest position, according to your last fact sheet, was Elementis.
Yes. So Elementis is a really interesting business. So it's a specialty chemicals company. But what's different about it to most specialty chemical businesses on the market is it's vertically integrated. It actually owns its own raw materials. So it has mines. It has the only mine in the world that mines a certain type of clay called hectorite out in the California-Nevada border. And it has a number of mines up in Finland which mine the highest grade talc in Europe. So we invested back in 2020 after the COVID pandemic had just really hit. It was one of the industrial names we decided to invest in. And part of the reason for that is that vertical integration. We look at the business and it's got market leading positions across a number of end markets. But importantly for us going into that downturn, the vertical integration meant that we felt it would be very capable of surviving any inflationary environment very well. You own your own raw materials. What's a better kind of a hedge against inflation than that going up over time? Alongside that, the group had been built up through M&A over time, and there was significant opportunity for cost out to be delivered by a management team. So it was, if you think about the kind of stories we like about good businesses that could be doing better, this was a good business, good assets, market-leading positions, margins probably weren't optimized, new growth engine probably could be accelerated, and there was a team in place starting to go through the process of delivering some of those changes. And so when we backed it, we thought, well, our entry price was, I think, at about half of tangible book value. And as I say, tangible book in this business has a real meaning. There's real assets in the ground there.
That's dirt cheap.
Yeah, so it felt a bit of a one-way bet, and that's what we're looking for. We're looking to get into businesses where we feel our entry price is very well underpinned, hopefully underpinned by plus something, where there's a number of levers a management team can do to improve their business, which makes it more valuable over time. But where your market position in attractive markets means that growth should come your way just as the market recovers. Elementis hit that. And so we have it one of our larger positions, mainly because there still is that asymmetry, we think, from where we are today. And indication of the value that might be there, the business received trade approaches in late 2020 from two strategic parties, got turned down by the board because they thought they significantly undervalued the potential of the business. But those bids were somewhere north of where the shares are today. So it's not without kind of macro headwinds, but there's enough to go for there. We're quite excited about the future.
Does it still have room for growth and efficiency savings?
It's still going. I think the management team have announced now, I think $19 million of savings over the next couple of years. I think there's a strong COVID recovery still to come in one of the divisions, the talc division, which sells quite significantly into European auto, which has been slow to recover from the pandemic. And exciting, the business has been quite strong at developing new products, notably for personal care markets. So think face creams, etc., lipsticks. And that's a market where innovation can actually drive growth, and they're doing quite well in that area as well. So there's a lot going on in the business.
This is a growth play then, rather than a sort of income play or a breakup play?
The way we think about investment is that we're greedy. And so when we make any investment, we like to have as many levers as possible. So yes, growth is true in Elementis' case. There's things they can do. There's also margin in that the business isn't run as efficiently as it can be, and there's cost to come out. There's cash flow. I mean, given you own your own raw materials, working capital absorption is less of an issue than for other industrials. This is a business that should generate a lot of cash, will pay down its slightly levered balance sheet over time. That's helpful. And as I said, we bought in at a rating which we felt was below fair value. And at some point, we feel the market will recognise the true value of the business. So we'd like as many different levers to drive the value case as possible, because if one wobbles, the other two will hopefully be fine. And if all come together, we hope we'll do very well. Which is why we don't typically think of ourselves as growth or value. We think of ourselves as something different. Typically, everything's a special situation with a story in our portfolio, and that's the kind of thing we look for.
So you're looking for sort of things that are 5-year plays, basically?
Yeah, typically.
And not putting a time limit on it.
No.
You're not looking for profits today. You're looking for the biggest profits, however long that might
Yeah,
take.
the way we tend to work is, you're right, our initial investment horizon is written on a 3 to 5 year basis. But over the life of the investment, you're always continually reinvesting. I mean, one of the learnings from my life is that every day you hold an asset is basically the same as the day you decide to buy it. Okay, every day you should re-underwrite your case. And if the investment is delivering and there's still more to go for, and it still remains one of the most attractive opportunities on our slate of things we're looking at, we'll run for much longer. We'll keep going. But but typically the horizon is multi-year rather than we think this is going to have a good quarter and the shares will pop.
That's interesting. So you're continually re-underwriting these positions. Is that every quarter or every week?
If you think about it, there are a number of things that change the attraction of investment. Okay, one can be news flow from the business. Obviously, is it doing what you thought you were going to do? Has it delivered the change you think it's going to deliver? The second key to any investment return is what's the share price today. So in a perfect world, all our investment cases start with a starting share price. We have a target in 3 to 5 years, and in the world of Excel, things go in a straight line from one to the other. In the world of the market, things don't go in a straight line. Sometimes things run very hard and the market gets overexcited. Sometimes the market doesn't appreciate a transformation for many years. And those mismatches, if you like, between market's view of value and what the true fair value as a case is delivered gives you opportunities to actively trim a position if it's run too hard too early, or maybe build it further if it's delivering but hasn't been appreciated by the market. So the re-underwriting process is about, do you believe your case, but also what's happened to the price, what's happened to the story, how's that shift your risk reward, and so how do you want to reflect that in your portfolio? So it's a very continuous thought process. And
Elementis is a big holding for you.
Yeah.
I mean, you don't have that many holdings in the portfolio anyway. I'm just interested how you go about looking at risk in that case. There are lots of ways to define risk, but you're doing the research and you're happy to own that position in a concentrated holding. How do you factor it in to your thinking?
Yes, this is a portfolio construction question. We think about risk really at a position level. So every investment we put in the ground we believe what we're very good at identifying is we're always looking for that, say, 15% base case return. But what we really like is businesses where we have high certainty that there's a low chance of losing money, okay? And hopefully there's some way you can beat that 15% return, but we like to protect your downside. One of the learnings, maybe start life in private equity particularly, is that if your portfolio is a concentrated few number of assets, the starting point for great returns is to avoid the loss makers at the bottom of the portfolio. Luck means that some things go very well, but really great returns start from if something goes bad, can you recover and drive some value out of that? So one of our learnings early on in our careers is that if you can avoid those loss makers, you're probably going to have a decent portfolio. So it starts at the individual position level. And then across the portfolio, we typically have weights that can be up to 10% of the NAV. And what drives the decision there is the balance of in that individual position, what is the skew of returns? Something like Elementis, we're very happy with it being a large position. Coming back to that kind of underpin of the asset value, we suspect the value of the mines is a significant portion of the current market cap of the business, for example. On that basis, there is, in our mind, limited downside. There's been historic strategic interest. It still trades significantly below its long-run averages. There's a number of reasons to believe that your downside option from here is limited. Now, markets can be volatile. That's the judgment. That's the challenge in our job, I guess, is making that risk-reward judgment. But we tend to, at asset level, try and focus on as many ways as possible to have our downside protected.
That's interesting. You were saying about asset value and the mine case there. I think asset value in general has fallen out of favour a little bit. People are more intangible assets. So you're saying that there's still a very good way of judging risk.
People often ask us what are some of the key metrics you look for on investment, and we do obviously run the full gamut of ratios and analyses, etc. But quite often, some of the most interesting ones to look at will be price to book value, enterprise value to sales, for example. These are metrics where sales and book value are typically harder to manipulate, shall I say, than earnings. They tend to be more consistent over time and pretty good indicators to where value is. So yeah, we do quite often come back to a few of those simple metrics just as sense checks to identify whether we think we're getting in at a sensible valuation. And price to book remains one of our favourite ones to go to.
So you said earlier that Elementis have had 2 offers so far, and I think your figures are since launch you've had 40% of the investments that you've been invested in have been taken out at significant premiums. Do you look at take out premium when you go into an investment?
Yeah, so we've been lucky, I guess, in a way, in that we've had so much takeout activity across the portfolio. But I always say that it's lucky, but we put ourselves in the way of the luck, as it were, because of the nature of the assets we're looking for, and importantly, how we think about valuation. So I always tell the story that when I started my career in private equity, I got sent on the British Venture Capital Association training course for boys in short trousers who start. And I think the first tutor at that course stood up and said was, the most important thing in private equity is the day you invest in an asset, know who you're going to sell it to and know why they're going to pay 30% more than you've just paid. And in a way, our mindset is very similar. So when we make any investment, we always look down, to use kind of public market metrics, but we also spend a lot of time thinking about who the right or best owner outside the public markets might be. So are there trade acquirers out there who will bring synergies, who would value on a different basis, who have the financial firepower to make a deal like this? Are there PE buyers out there? Maybe they have something in the portfolio that's relevant. What's the financing market like for PE buyers? What's the return requirement they would like, and what's that mean for the valuation? And it's not because we think everything in the portfolio will get taken out, but it kind of back to this kind of, can we find assets where our downside is capped? If you buy a high quality business with a decent management team, which is trading below its value to a trade peer or a private equity buyer, and there are no poison pills, if the market is persistently wrong in its valuation it applies to that business, the chances are that there might be something that happens, and that's how you put yourself in the way of those takeouts. Now, impossible to predict. Maybe some more will come, but the portfolio we think is very attractive, and at current valuations, if the market doesn't put fair value on the assets we've invested in, we think someone else would.
And of course, PE is very active in the UK as well, because it's the right valuations and the right opportunities. Yeah,
it's interesting. We came into this year and we actually said at our year-end results, we thought the private equity activity would be very subdued throughout the whole of 2023 as the industry digests the change in the cost of debt. Actually, we were quite surprised that the market remained pretty active through the first quarter. It's since become much quieter through the summer, but we're beginning again to see some early signs of trade deals of private equity deals happening in our space. Again, because, as you say, the UK market is, we think, very attractively valued. I think that will continue and probably accelerate as that kind of matching of buyer expectations to seller expectations as the cost of debt flows through the market, washes out. I think what then gets us more excited actually is when trade buyers come back to play. We always get disappointed if one of our assets get bid for by a private equity player who brings no synergies. We'd rather see a trade buyer who brings something to the table beyond just financial engineering, because they typically pay a better price. And we think from a trade buyer's perspective, they typically like to see a bottom to the cycle before they start really kind of opening their checkbooks again. And for us, that means it's probably sometime next year before you really see trade buyers coming back to play. You can't tell for certain, but at some point, we think M&A will be a really interesting factor in the market again.
Talking of M&A, one of your largest positions is Essential. And this is a really fascinating example of how your strategy plays out, because you've got this business that's sold a division, or is in the process of selling a division, which will give a lot of book value support.
Yeah, so Essential is a really interesting business. It's a collection of B2B media assets, and there's three different parts to it. There's a group of events. So one's Cannes Lions, one's the biggest fintech event in the world, Money 2020. Then there's a collection of assets under the digital commerce header, which are businesses that help companies sell on Amazon and other online portals. So very fast growth, very exciting market. And then there's a collection of assets involved in product design, the largest of which is WGSN, which helps those in the fashion and consumer goods industry the forecast trends going forward. So quite disparate businesses. Our investment thesis was underpinned that there was a significant discount in the market's valuation versus the sum of the parts of those individual assets. So we were quite pleased to see in January the management stand up and say that they were aware of this discount and they were going to try and take action to close it by breaking the business up, initially by selling one of the divisions, as you say, and then subsequently listing a second one on NASDAQ in due course. So we're positive on that. We continue to believe that the shares are today undervaluing the true sum of the parts value of the business. And we look forward to hearing news on what may or may not happen on the disposal of that division. It's obviously not the best time to be selling assets, so who knows what will happen, but it's a very high quality business they're trying to sell. So we think whatever the outcome is, the story of there's a strong sum of the parts discount for a collection of assets which are market leaders in their niche with some self-help to go for, it's a story we like.
Can you explain a bit about how big the valuation gap here is? What's the opportunity? What's the sum of the parts? Given a rough guide, what's the sum of the parts value and what's the market missing? How big is the value gap?
We think it's quite significant. So you can run a variety of analyses to value the different parts of the business. And you can look at analyst commentary when they announced the breakup of the business. And I think you saw analysts pointing towards valuations of anywhere around £3 to somewhere north of around £3.50, for example. And the shares today trade around £2.10, depending on what day we're on. So there's obviously a significant gap there. Now, we have our own views of the valuation of the business units, and we come up with our own target, but it's suffice to say we think there's a significant mismatch. And part of this is due to the complexity of the group, partly that's due to the understanding, and partly due to the lack of interest in the UK market. Coming back to our discussion about flows, we built our stake last year, and I think we were one of only two buyers of the shares from UK-listed funds.
Right, yeah. In the market?
In the market.
So just no one's interested?
I think there were a number of holders on the register who had outflows, and there was not much interest in buying. And so one of the reasons why the shares are, we think, undervalued is because of that dynamic in the market persisting.
And there's growth there as well as the potential value from the breakup.
Certainly, particularly on the digital commerce assets, help people sell on Amazon. That's a business that grows driven by how much retail transaction there is on Amazon, how much marketing the spend is on the Amazon platforms. That's a very exciting growth market. The asset around kind of forecasting fashion trends, that's historically grown at mid-single digits as it expands into new verticals, and we think it can continue to do so. And then their events businesses have scope to grow both as the COVID recovery continues and also as they roll out across new geographies. So a number of different ways. Kind of again back to our greedy look for everything story. It's got growth, it has some self-help. We think there's a valuation underpin, and the business should generate cash along the way. So hopefully a number of different ways it can create value over time.
Well, on that very interesting note, thank you for your time today. It's been
Thank you.
Very informative.
Pleasure.
Cheers.